Hello friends, welcome to today's session. Here is a solution to our self-assessment question on issue of debentures as collateral security. The question that was posed to you was that there was a Porter Limited which had taken a loan of rupees 10 lakh from State Bank of India and they had issued 8% 12,000 debentures of 100 each. So 12,000 debentures of 100 each. The collateral given was for 12 lakh rupees. The loan taken was 10 lakh. They have asked us show how the issued debentures will be shown in the balance sheet. A. When no journal entry is passed, and B. When journal entry is passed. And further, if Porter Limited finds itself unable to repay the loan along with interest of 2 lakh and the bank exercises its rights towards debentures issued as collateral security, then pass journal entry in the books of Porter Limited. So first we will deal with how it is to be shown in the balance sheet in the two different situations. First one, when no journal entry is passed. It's as simple. When journal entry is not passed, we just disclose it in the balance sheet by way of an explanation. So the main balance sheet, the extract is being prepared as at whatever is the end of the year, 31st March of whichever year. First one, equity and liabilities. Under that, whether it is a long-term borrowing or short-term borrowing would decide whether it would come under non-current liability or current liability. So if it is a long-term borrowing, it would come under non-current liability. And if it is a short-term borrowing, it would come under current liability. So here, as nothing is specified, we'll assume it's a long-term borrowing. And therefore, the head would be, the main head is non-current liabilities. Under that, we had the head of long-term borrowings. And we will give the note number, say, as 1. So in notes to accounts, note number 1, we are going to have the head long-term borrowing. And the borrowing is nothing but our bank loan from State Bank of India, which is an amount of rupees 10 lakh. Now, as no journal entry is being passed, it is just going to be revealed here that 12,000, what was the percentage of debentures? It was 8%. So 12,000, 8% debentures of rupees 100 each issued as collateral security. So this is the detail given and this is the way it is going to be revealed when no journal entry is passed. And therefore this amount would come into our balance sheet total. The second is when journal entry is passed. So when journal entry is passed, first the journal entry that would pass would be, we would debit the debenture suspense account with 12 lakh rupees and we would credit the 8% debentures account with the 12 lakh rupees. And the narration that we'll be writing is issue of 12,000 8% debentures of rupees 100 each issued as collateral security to State Bank of India. And once having passed this journal entry, now we are going to show how it will be shown in the balance sheet. Again, it would be under the liability side. So by first one, equity and liabilities. Under that, we would be writing the non-current liability, assuming that's a long-term borrowing. If they have specified it's a short-term borrowing, please do change it to current liability. And then we write long-term borrowings. is going to be note number 1. So under long-term borrowing, we have the bank loan from State Bank of India, the 10 lakh rupees. And now because journal entry has been passed, you're going to reveal that in the notes to accounts as 12,000 8% debentures of rupees 100 each issued as collateral security would be 12 lakh, but we have debited debenture suspense, so that would come here as less debenture suspense account, that is 12 lakh. So net amount nil. So the total of this 10 lakh is what the loan amount which goes into our balance sheet. So this is how when we pass a journal entry to record the issued debentures collateral security, we reveal it in the notes to accounts. Once that is done, next they have given us this particular situation that if it is unable to repay and the interest payable was 2 lakh. So there was a loan of 10 lakh and 2 lakh interest payable, and they have now, the bank has exercised the right towards their debentures which is given as collateral security for 12 lakh. So first thing, the journal entry that would be passed by the at the year end 2021 or 2022, whatever is the year they have given, that at the year end you would be first reversing the entry passed. In case the entry was passed like this, you have to first reverse this particular entry. No entry is passed, as in the first case, nothing to be done. But if journal entry was passed when the debentures were issued as collateral security, remember to reverse that entry. So it is going to be 8% debentures account debit 12 lakh to debenture suspense account 12 lakh. This is for 8% debentures issued as collateral security reversed. Now, there was a loan amount of 10 lakh and interest payable of 2 lakh. Total 12 lakh of liability, which is now going to get replaced by means of issue of debentures. So next entry would be where we would close out the credit in the loan account by debiting it of 10 lakh. And the interest payable, which is a liability, is also closed out by giving a debit to it of 2 lakh. And this is going to be settled by issue of 8% debentures to the State Bank for 12 lakh. So this is for conversion of 8% debentures issued as collateral security into 8% debentures liability. So you have converted the collateral security 8% debentures into 8% debentures, which is now a liability. So this is how it is going to get settled, and this is the journal entry that would be passed. I hope it was clear. I hope this video was helpful to you. If you found this video useful, please do like and share it, and please leave your valuable comments so that it will be very encouraging to us and also would be guiding factor to us to enable us to make better videos. Thank you. And if you have not subscribed to the channel, please do subscribe to the channel to get continued notification of all the upcoming videos. Have a great day.